Hey, all, I'm Tyler Olson. I'm your host. Welcome to the podcast, A Good Problem to Have. Today, we're going to be talking about having $150,000 in student loans. Why in the world would I say that that's a good problem? Because a lot of times it's $300,000, $400,000, $500,000 in student loans that physicians come out of training with. And $150,000, when I hear that, when someone tells me that, and they know it too, it's like, oh, wow, that's not very much at all. Of course, $150,000 in student loans is quite a bit in debt. It's no small sum, but it is something that needs to be addressed in a different way, because while all that debt is, a variety, different varieties of high debt, it's one that will have a different subset of pros and cons from like a $400,000 debt. And we're going to be talking about two areas, PSLF, and if not going for PSLF, how to pay it off. First, let's talk about why PSLF is relevant here. It's a common option that physicians look at because if you're going to be continuing to work in a nonprofit setting after training, then you may be able to complete 10 years worth of nonprofit work and have a measure of your student loans forgiven. It's been very useful for many physicians that I know. And, if you've got a lot of debt, it's at least worth considering. But when you have, say, $150,000 in debt or even less, like 110 or 100,000, depending on how much income you're going to be earning after training, PSLF is significantly less appealing because there's just not as much debt to be forgiven once all the required payments take place between when you complete your training and when you would hit your 120th PSLF payment. Especially in today's environment where there's a lot of efforts from the administration to, they may want to get rid of PSLF, but even if not that, they're trying to make it more difficult to achieve PSLF. And a really important area of financial planning for me is being able to find a workable and controllable path. There's some things that we can never control. And sometimes there's things that, like, if you've got $450,000 in student debt, PSLF is worth considering heavily because that alternatively, if you were to pay it off yourself, would result in a very high monthly payment. And so as your debt goes up, PSLF has more appeal, but with less, it has less appeal. And because it's a government program, you have really no control over what a future administration may do, whereas paying it off is significantly more within your control. So when someone has the problem of dealing with $150,000 in student loans to pay off, I tend to favor a payoff plan because it's a lot more knowable and predictable. There's a lot of peace of mind that goes with that. So as you evaluate your own student loan situation, if you're someone that got some scholarships or you got help from family, and so, for whatever reason, your student loans are not that high, then PSLF may not be the best way for you. And it's okay, even if you were to work in academic medicine and technically qualify for it, you could pivot to just say, I'm just going to knock this out. I'm going to figure out a payoff plan over the course of a 5, 7, 10-year period because I want a track that I know, that I can see. So let's make the assumption that you decided, I'm not going to go for PSLF. I'm going to pay this off. You have two options that you can consider, and both of them are okay. The first is to stay in the federal umbrella. The second is to refinance. There's a primary benefit to each one. The primary benefit to staying in the federal system is that if anything were to ever happen with your income, say you became disabled. Now, disability insurance, that's something we'll talk about some other time, but disability insurance should play a central role in being able to provide help for you in that case. But even then, if you were in a federal loan, like the standard 10-year repayment, or even on an income-driven repayment plan, the payment amount can go down on the income-driven repayment plans as your income does. So if something happened with your income, your required payment would go down, and that would relieve some pressure for you in that situation. Now, I don't like to plan on that happening, and it's unlikely, but it is a possibility. And so what you could do is stay within the federal program, aggressively pay it down. You can make payments that are higher than the required payment, just to chip away at the principal. And the purpose of it is to pursue your goal of paying it off aggressively and not relying on public service loan forgiveness, but also still having that backup plan that, well, you're still in the federal system. You could decide to leave it there so that if something were to happen with your income level, it would commensurately reduce the pressure on how much you must pay per month on your student loans. The benefit of refinancing often has been to get a lower interest rate, which reduces your interest expense. You're paying money to borrow the money that you paid for tuition. Sometimes with private lenders, you can lock in a lower interest rate. That hasn't always been the case, especially in 2024 and in the early months here of 2025 so far. The rates haven't been that much lower than federal loans, especially for those of you that graduated medical school a number of years ago, where your average interest rate has been like 6.5%. But and that obviously new loan rates are higher, like 8.5%, 9% even. But in any case, you want to compare what the rate difference would be. I have seen lower rates like in the second half of 2025. And so if you have an intention of taking your student loans, like you're going to pay it off, refinancing can save you money because the interest expense is less than your federal loan rate charges you. Now, the cons, of course, is that once you're in a private loan, there is no income-driven repayment plan option. You are on that track and you have to pay it. If you don't, then you go into default, and that creates issues for your credit score, and you don't want that to happen. The downside, of course, on the federal loans would be that maybe you're accepting a higher interest rate than what you could get with a private lender in exchange for that backup plan of being able to fall back on an income-driven repayment plan if that were to happen. But in any case, if you're in that situation where your student loans are in the $100,000 to $200,000 range, and you think that it may appeal to you and your financial situation to just aggressively pay it off yourself, and this would especially be the case for those of you that are in higher paying specialties. Like if you're making $500,000, $600,000, $700,000 a year, like there is a lot of value in being able to take control of this thing and knock it out yourself. But everyone's situation is different. So you need to evaluate your income and your debt, your living expenses, and how you feel about debt, how you feel about partially relying on a government program like PSLF versus being able to arrest control and proceed with your plan under a more controlled path. So $150,000 in student loans, it's no small sum. I'm not trying to say that it's nothing, but it's certainly a lot lower than a lot of other physicians. And so if this is you, these are the decisions and pros and cons that you need to make. Thanks for listening today. I'll see you soon.